Lowami from ITTL. Today we're going to talk about an interesting topic, still in stocks, okay? Because we've gone a bit inside, okay? We've gone beyond just investing in general, and we're just talking about stocks. And what we are talking about today is how your money make money in stocks, okay? Which is like, of course, we at Young Investors Movement, we just want to train you how to use your money to work for you. And this is what we're going to be talking about now. How does your money make money in stocks? How does your money work for you in stocks, okay? So, if you're just new, let me introduce to you what we're doing. This is the Young Investors Movement, and we are just a movement of young people who are interested in having money work for them instead of just working for money. Okay, we just keep our jobs if we have one. We keep our tasks, like we just keep working if we have one. But the money we just get, we use that to work for us. Okay, so getting into the topic. I need to be very quick. Getting to the topic. There are three ways that when you buy a company, a stock, okay? Remember, a stock is a unit of ownership in a company. There are three ways that when you buy a stock in a company, that stock can make money for you. We're going to be talking about two of them because the third one involves something we call stock options and premium, and that is very complex for now. We're not going to talk about that. Instead, we're going to talk about dividends and capital gain. Okay? Most of you might be familiar with earning through dividends, because dividends usually mean return on your money. And return on your money means you just gave the company some money and they just used it into their activities. Now they made a net profit and they're just splitting a portion of that profit to just give you back, okay? Which is if a company made some profit, like let's say it made 10 millions in profit, okay, and then you just have some shares, so dividend is a part you will get when the company announces that it's going to get a dividend. That is, if you have a share in that company, you're getting a small portion of that profit, that cash that they have, because you just are one of the owners of that company. That's what we call dividends, okay? Usually when I see just like dividends may range somewhere from 2 to 12% depending on the company, the industry they work in, and the economy, the situation they are in that time. Some industries like these energy industries or utilities or real estate, they just pay high dividends. Like real estate, they pay between 8 and 12 because they don't have anything to just do with that money that's coming. But if we're talking about something like technology or biotechnology or any tech related stuff, these guys invest a lot of money into research and development. And as a result, they just don't give much in dividend. Okay, that was dividends. And now let's talk about my favorite one that I love, which is capital gain. Usually capital gain goes with the type of stocks that we call growth stocks. And now these are companies that might not be paying any dividend. That's, you're not getting any return on your money. But these companies are expected to grow, and when they grow, many people get attracted to this company. Yes, so that was dividends. Now let's talk about capital gain, which is my favorite way of just earning money into stocks, because as I told you, dividends might earn something between 2 to 12, okay? Which, if you factor in inflation, it becomes a really big deal, okay? But when we're talking about capital gain, it's a wholly different thing, because in capital gain everything is possible, but there might also be capital loss, okay? So I'm talking about the way money make money, but if you don't follow it, money may lose money. So how does capital gain work? Usually in capital gain, we're just investing in a type of stocks that we call growth stocks. So these kind of companies do not actually pay dividends, as they are making a small profit and they want to invest it to grow. Okay, so they don't just pay any dividends. Like a few of them pay dividend, but it's minimal, it's small. Okay, now how does your money grow in a company like this? Your money grows, but when a company grows, they just extend the reach, the distribution, they just gain more in the market share, and at the end they sell more. When they sell more, they make more profit, and they keep investing in growth. And as wide as it grows, that's the point where many people start thinking, wait, this company is worth a buy. And when many people just come for that company, and you already have stocks in that companies that, like, the stock price rises in level. This is something I can say about the stock market works on supply and demand, and capital gain is the difference between supply and demand over time. If you are in a company that's growing, that means the supply of the stocks are gonna be limited, but in the long run the demand is going higher because the company is growing. Do you understand? So in this case, this is when your money make more money. Like if you bought, I'm gonna give you an example, okay? In 2013, when the Facebook went public, okay, I think I'll show you a chart. When Facebook went public, it was trading somewhere around $19 a share, no, $23 a share, and after that it went to $19 a share. Somebody who bought in that time and led Facebook to really grow their portfolio, now just like the stock of Facebook is at 200 and stuff per share, over $200 a share. And somebody who bought in that time, you see, they've made like 10x their money in 7 years. Okay, so that's an example of capital gain. That is, if you had in one share worth $19, and in 2020 your share is worth $200. Okay, that's what we call capital gain, and it's my favorite way of gaining money through stocks. That is, you just buy a company that's undervalued, that's a growth stock, and you let it grow, and when it grows it attracts more investors, and more investors, the more investors attracted to there, the more your money rises in value, because they're wanting something that you have. Okay, so that is the second way. Now, like if you bought a stock at 5 and now it's climbed all the way high to 15, then you just have like 3x your money, and you understand, the 3 times your money. That's how that's possible in capital gain, but 15% return on your money, that's the highest in dividends. Okay, but usually the risks even vary. Like if you're investing into capital gain, there are more risks of capital loss. But in dividends, there are just few risks. Okay, as always, high risks, high rewards. And we're gonna talk about the risks in stock market in the future videos, and I hope you just stay in touch. Thank you very much for following. This is the Young Investors Movement. Remember, there is a Facebook group where we just interact with everybody who wants to talk about stocks, and usually investing in general, not only stocks. So thank you very much for following until the end. If you just reached here, that means you're committed, and we're committed to you.